Greetings to everyone and hope your new year began well and hope the new year remains a fantastic year for everyone. Well, I'm here to talk about quantum advisors and the India investment opportunity and why we consider ourselves as pioneers of investing in India. So in January 1990s, when I started Quantum 34 years ago, and in February of 1990, I wrote an article in the then Asian Wall Street Journal titled Loosen the Reins on India's Bull Market, basically suggesting that if the government of India opened up the economy and had some policy changes in place, India's GDP and market cap would increase. And lo and behold, we've seen those numbers right there. India's GDP grew from $150 billion in 1990 to over $3 trillion now. And India's market cap grew from 20 billion in 1990 to over $5 trillion now. What we've also seen, if you go back a few hundred years in history, the share of global GDP by India, marked in the yellow, was significantly higher than what it is today. And over time, because of the Industrial Revolution, and then again, the closed economy or the socialist policies of India, India's share of global GDP began to shrink, as shown in the yellow. And after India's reforms from 1991 July, which was 18 months after I wrote the article in the Wall Street Journal, Asian Wall Street Journal, you've seen the India's share of global GDP depicted in the yellow increasing. And everyone expects it. The IMF, the World Bank, the Asian Development Bank expect that share of GDP to continue increasing over the few decades. Within the Indian context, since 1980 till now, we've had 11 governments. And what we've shown here is a rate of growth of GDP in India while each government was in power. So the yellow band reflects that, and the blue band reflects that same time period, what was the per annum rate of growth at the global economy. Broadly speaking, there are a few nice indications from this. On average, over those 44 years, India's GDP grew by 6.2%, as seen in the green line right on top. And what you can also eyeball and see is that the yellow and orange bar of India's GDP has been higher than the blue bar of global GDP across all governments and across all cycles and market conditions, roughly by twice the global rate of growth in GDP. What we also see, surprisingly, is that in the x-axis, we have indicated coalition governments in red and single-party governments in black. And what you can eyeball from here is that while coalition governments were in power, marked in the red, GDP tended to be higher or closer to that long-term average than when single-party governments, marked in black, were in power. The other linkage is between GDP and stock market returns in any country, in any economy. In the Indian context, the black line shows how GDP has grown over the decades, and the green line indicates the MSCI India returns in dollars. And you can see that fairly strong fit, fairly tight fit between stock market returns tracking rate of growth in GDP. There are moments of time, of course, like in 2005, 6, 7, when stock market returns, as shown in the MSCI India index in green, were much higher than what the GDP would suggest. And there were periods of time from 2011 to 2019-20 when the GDP was higher and stock market returns didn't quite track that rate of growth of GDP. And of course, now in more recent times, you can again see the green line of stock market returns being higher than what the GDP of India would suggest. That's one indicator. The other thing that I should love to talk about is our own history. So, three parts to our story. I spoke about the Wall Street Journal article. That was a concept that India would open up. It did in July 1991. And we had the first international joint venture between a foreign company and an Indian company in the field of finance in 1992. And at the end of that central section of the student, you can see our partnership with Tom Hansberger, which defined our long-term investment value-driven philosophy. I worked with Tom for 7 years and I lived in Fort Lauderdale. He taught us valuation metrics And also, while I was with him, I got to manage a Vanguard International Value Fund. So Tom's team, Hansberger Global Investors, was the outsourced external manager for that fund, and I was the lead manager on the account. I left the US and I left Hansberger in 2004, went back to India, and of course, Subbu and I, we decided to raise capital under our own brand name. Subbu joined Quantum in 1996, and that was also the year when we introduced the integrity screen, and I'll talk more about that in a minute. Our approach is long term, as I indicated. And of course, when you leave the comfort of your home country and your home continent and you go to a foreign market to invest, you're taking a risk. Our job, we see, is not to increase that risk, but to assess that risk, to price that risk, and to calibrate that risk when we build the portfolio for the India Value Equity Fund. What we also do is to ensure that the companies we invest in are liquid. They have a daily trading volume of at least $1 million a day, as compared to thousands of companies which may not trade a lot. So in India, you have over 4,000 listed companies. Roughly 1,200 of those trade more than $1 million a day. And on those 12 companies, we put another metric that I referred to earlier, which is the integrity screen. The year before I started Quantum, which was in 1989, I met a gentleman from South Africa, and sadly, I don't remember his name. He asked me, he said, young man, was younger then, what would you like to do? And I said, set up an investment firm. He said, I have one advice for you. When you shake someone's hand and you get your hand back, count your fingers. If you don't have 5 fingers, do not shake their hands again. I didn't quite understand what that meant at the right young age of 29, but we did understand that in 1996. And Subbu and I decided to put in place the integrity screen to basically sift out companies where we believe that corporate governance is not too good and the rule of law in terms of looking after minority shareholder interest may not be enforced. So that integrity screen is a very, very integral part and important part of our investment process, as is what Tom taught us, understanding the intrinsic value of a company. And once we have that number and we know the share price, so if the share price is below the intrinsic value, the long-term intrinsic value, we're probably buyers of the share. And if the share price tends to be higher than the intrinsic value, we're probably sellers of the share intuitively. The other thing that's important to know is that we are long-term. We've owned some companies for a decade. So we're not traders. We're very thoughtful, very careful, very measured when we make our investments. And these, we believe, are the advantages of looking at the India Equity Fund, which we are launching now. And we really hope that when you consult your financial advisors, when you read the prospectus, and when you try to understand more about what I just spoke about, you will recognize that India indeed is an attractive long-term growth market. But for all the noise, for all the color, we need to be very, very careful that we deploy the capital that you've entrusted us with in the fund in a long-term, sensible manner. Thank you very much, and happy investing and careful investing.